Hi, welcome to Ms. Richardson's U.S. History 5-Minute Lectures. This information will be U.S. Notes 2.6, the stock market in the 1920s. It includes information that aligns with the second section of your Unit 2 study guide. Now remember, you control this lecture, so pause whenever you need, write down your questions, rewatch it as often as you need, and always make sure you're using your study guide to help you take notes. Let's go ahead and get started. As I mentioned in the last set of notes, the economy in the 1920s was booming. Life was good for Americans in most sectors of society. Jobs were plentiful, prices were low, and all sorts of new technologies were available. Most Americans had extra money to spend, and they spent this disposable income on those new technologies and on entertainment. One other area where these people could spend their extra money was the stock market. This was not really spending money, but rather investing money. By buying stocks at low prices, holding on to them, and then selling them at higher prices, individuals could make more money to live and to spend on luxuries. You've experienced this in class with the stock market game. Most of you have made at least a little bit of money so far by buying and selling the different stocks. It gave people in the 20s extra money, but it didn't make most of middle-class Americans rich. So how could these middle-class Americans with a little extra money, but not thousands and thousands of extra dollars, get rich? Well, there was actually a way. They could buy on margin, like I showed you in class. This allowed regular people to buy more stock at low prices and then sell at high prices and increase their profits. So I showed you this in class, but I want to talk about it again quickly here. The basic idea was that the investor would only put down, say, 10% of the money needed to buy the stocks. The broker would then loan the investor the other 90%, with the promise that it would be paid back when the investor sells the stock. This allowed the investor to buy more stocks for the same amount of money. That meant they could actually make more money in the long run. So you should remember this from class. You have $100 and the stock costs $10 per share. You can buy 10 shares. If the price rises to $20 per share and you sell, you would have $200. So you made $100. On margin, you have $100 and the stock's $10 per share. You buy 100 shares because you put $100 or 10% down of the $1,000 cost. You borrow the other $900 from the broker. If the price rises to $20 per share and you sell, you would have $2,000. And after paying the broker back the $900 you borrowed, you would still have $1,100, which means you made $1,000 profit. So you can see you get much more money if you buy on margin, but there's a lot more risk. This worked well in the 1920s because the stock market just kept rising. Companies were making more and more money each month, selling more and more new goods to consumers, and as long as the economy continued to grow, there seemed to be very little risk and a lot of reward for investing in the stock market and buying on margin. We know today that the market does not always rise, and in the 1920s, it had to slow down eventually, and that slowdown would have enormous impacts in society. So there was one group that didn't have any extra money. They didn't get to invest in the stock market, and they were still struggling throughout this whole time period, and that was the farmers. So if you're a farmer in class, sorry, you're not really going to get a lot of extra bonuses. So there were some farmers that were able to invest a little in the stock market, but in reality, most were just trying to make ends meet during the 20s. So this is the end of US Notes 2.6. I hope you learned something, and I'll see you in class with any of your questions.